Hi everyone, it's Mike from Order Flows and welcome to the Advanced Order Flow Trading course. This is Module 1, Principles of Order Flow. Now before I begin, a brief disclaimer, trading involves risk, right? Don't trade with money you can't afford to lose. The reason being for that is because the only thing easier than making money in the market is losing it. Majority of traders come to the market and they promptly lose money. And the reason being for that most often than not is traders tend to just focus on price going up and down. You see people posting charts everywhere online, in chat rooms and emails, whatever. And, they just focusing solely on price. Well, this is what happened when price reached here, or, price sold off to this level. They're not taking into account what's actually happening to the market. And you need to look at factors such as volume, delta, imbalances, points of controls, the basics of order flow, basically. Much in the same way as driving, right? You have to drive with the flow of traffic. You have to trade with the flow of trading. If you remember when you learn how to drive, one of the most important parts of your education is defensive driving. You must be aware of what else is happening on the road besides just being focused on the car in front of you. And most traders are just focused solely on price. You have to look at the surroundings, what the car in front of him is doing, the car to your right, the car to your left is doing. This is a volume footprint chart. This is the order flows trader chart. And, if you're just following the flow of the market, you can see how when we hit our high earlier, you have resistance coming in with the prominent points of controls. We start selling off. You see we've got selling imbalances coming in there. You see the delta is negative, right? Then we hit this area of support. You have a prominent point of control, a bullish one, this blue color. Then the market starts going up. You see buying imbalances appearing. You see positive delta coming in. You see we get this big spike up. Then up here at the new high, we have a bearish prominent point of control. We have 1, 2, 3 imbalances in the bar. We have a divergence. We got a new high with negative delta, and the market starts selling off. All too often people look at a chart and they see a high and they figure out what's happened from there. But you know what? There's a lot of trading going on in between the high and the low. And you have to think ahead. Oftentimes traders become overly focused on past price action. You have to start thinking in terms of what can happen next. For example, what can happen if price don't break the highs? How are you going to set yourself to react to that in the market? How is a high or low made? That's a question you should always be asking yourself. The longer the market stays at the lows without taking them out, without downside follow through, the higher the chances that the market is going to rally off those lows. Because the shorts are getting nervous as they aren't getting paid on their shorts. And the same is true at highs of the day. When the market makes the high of the day, just as we just did in this chart here, you should be asking yourself, are we going higher or are we going lower? If you see something happening in the order flow immediately, you can get short. And there's a great signals in the order flow. You got your divergence, you got your bearish prominent point of control, you've got your selling imbalances, you got your negative delta. Everything is pointing to a bearish sign. Rather than let the market sell off before you get short immediately, just right off those highs. So you got to be watching what's happening in the order flow, the delta, the imbalances, and the volumes, and the points of controls. Ask yourself, what is the pace of the market doing? But more importantly, you got to ask yourself, are traders getting paid? Right? We're coming up to the highs. We're up here at the highs, spike up, make a new high, spike up again. People are long, but we're not going anywhere, right? Are these people that are getting long up here, are they getting paid? The market's just going sideways. If they're not getting paid, what are they going to do? Do you think they're just going to hold their position? Any sign of weakness, they're going to get out. They're starting to see some signs of weakness in here. And then boom, the market just drops off to where we were earlier. You could see it in the order flow. You could see the selling imbalances. You could see the ratios up here. You could see the divergences. You could see the points of control up near the tops of, this bar right here. You could see the small prints coming in here. There's more reasons to be getting short than necessarily to be getting long. All this time the market had the opportunity to go higher. Why didn't it? Where were those buyers? You got that last ditch effort right here to go a little bit higher. Can't even get up to the high of the day before people just say, you know what, I'm done with this position, just get me out. and then the market sells off, retraces that whole move back down. When we're at the low of the day, are the shorts getting paid anymore? People are getting short, aggressively getting short. Got these big move down, strong negative delta. Okay, well, are we going to go to zero? This is crude oil. We're at 57 right now. The low is 57.21. Watch the order flow. See what's happening in the order flow. You can see the delta is nice and positive, strong down here at the low, positive 243. Next bar, positive 280. You've got paired up points of control. First one is a prominent point of control. That's this blue area. Next bar, also not a prominent point of control, but towards the bottom of the bar. And you got some buying imbalances coming in there. Sure, you've got one red bar with that bearish prominent point of control, but the delta is still positive. So that there's buying going on in there. Next bar, doji candle, open and close at the same level. Still positive delta. Then just goes sideways a couple bars, and then the strong positive delta here, 329. More importantly, what's happening in these points of controls? From just these three bars, you got point of control at 57.26, then it's higher, it pairs it up, next bar, it's higher. So even if you're not convinced at this low, as you're starting to move away, take into account what's happening with the point of controls migrating higher, with the delta getting, stronger initially and then staying positive, for finally it starts popping 57.40. Boom, in the next 15 minutes rallies 25 cents. Now, breakouts, right? When the market breaks a level, there needs to be acceptance. If there's no acceptance, then price will most likely revert back into the range. But what is acceptance? Well, there's going to be follow through, right? It can be seen in volume. Is there decent volume going through? It can be seen in imbalances. Is there aggressive trading going on? It can be seen in points of controls. Are point of controls migrating either higher or lower? It can be seen in delta. Is the delta strong or weak? Here's a good example. All right, market is just going sideways. Right, you've come into an area where price is being accepted. Now you get the breakout. What do you got? You got the strong negative delta. Actually, you had the strong negative delta one bar earlier than this breakout bar. But you see the big aggressive selling coming in here. Point of control, down at the bottom of the bar. This is a 5-minute gold chart. The volume, massive, 9,000. When earlier you're trading 1,000, 2,000, 2,000, 900, 900. So you're looking at almost 10 times the volume that you were trading earlier. So it's breaking out. That's what you like to see, a healthy breakout. You like to see strong negative delta if it's a breakout to the downside. You like to see selling imbalances, someone just coming in there hitting all the bids on a breakout to the downside. You like to see heavy volume, where levels are just getting taken out. Big volume on the bid side is being taken out on the move lower, right? Then we trade down, rally back up a little bit, and break some more. Profiting from places where other traders are wrong, in failed breakouts, watch the trend lines. When the market pierces through a trend line, all the price action traders rush to get in long, but often they get trapped. What's happening in the order flow that you can profit from? Always be watching the order flow. Profit from other people's mistakes, right? Market sold off quite aggressively. You get down to this bar down here at the low. Look at this. You got stacked selling imbalance at the low of this move. Boom, boom, boom. Someone just hit every bid there. Market snapped back up. Well, we're trading above that selling imbalance. That's not a good sign, right? If you've got a selling imbalance like you have here, you should be trading below it. So what you have here is traders made a mistake. Traders are trapped now. We're trading much higher. They got to cover. It's a nice short-term move. Trading from the 82.63 area all the way back up towards the 70 area before some selling comes in again. But this move right here, you could have caught that if you notice that traders made a mistake in selling down here. The market got overextended and they just sold too much. The market absorbed it. Market snapped right back up. When there's too strong two-sided trades, breakouts usually fail. So look for breakouts on one-sided trading. And what that means is, if there's healthy volume on, what was traded on the bid, what was traded on the offer, it's going to be hard for the market to break out because no side is really in control. It's basically evenly matched. Here we have a lot of nice two-sided trades before this breakout, or breakdown rather. You got decent volumes going through, in the 600s, 900s, but more importantly, look at the deltas. You can see how evenly matched it is, right? Volumes are nice. Okay, so you see 1,000, 600, 697, 600, 699, 900, etc., 800. But you look at the deltas: 54, 23, 70, 21, 55, 43, 94, 11, 32, 3, 1, 30. So buyers and sellers are, for the most part, evenly matched. Then what happens? You start seeing the strong one-sided trade coming in. Minus 189, minus 244. Now, how does this differ than, you have this bar right here with the positive delta of 282? Well, there was no follow through, right? If the next bar came in here with, a delta of 320 instead of just 32, it would probably be trading much higher. But there was no follow through in the order flow. Now you got some selling coming into the market. It backs it up with another strong negative delta, more aggressive selling coming in, following it up. And we start breaking down from this range that we're in. And then, look out below. Would you rather be getting short here or be looking to buy? Why would you be looking to buy when you have aggressive sellers dominating the market over the last couple of bars? You're not going to be looking to buy down here. You're going to be looking to get short instead. Again, more two-sided trade going on here. All right, you got decent volumes. 4,000, 5,000, 4,000, 400, 4,000, 3,6, 5,8, 4,3, 7,000, 4,000, 3,7, 7,7, 4,4. So it's decent volumes, right? And the deltas, as you come down into this low, are getting small. 388, 132, 141. Right, then boom, 529, nice strong. Minus 290, okay. Then positive 161, positive 1095. And then the market starts moving back up, but then we start getting into the small deltas again. 28, 157, 46. So, the move from this low up to this high, thinking, oh, this is it, we're going to just retrace back the range that we're in and we're going to finally break out. It's not materializing. We come back into this area of acceptance again. We hit the bottom of the range, we hit the top of the range, and then we start contracting on the delta. It's getting small again, 28, 157, 46. If you're looking for this move to continue back up, you're not going to want negative delta as soon as you get back up to the previous high of minus 500. Then 194, yeah, okay, that's positive. But then 300, you don't want to see that. Minus 600, no, you want to be seeing, if this market's going to break out of here, you want to be seeing, positive 500, positive 800, positive 600. You want to see strong positive deltas, not just sort of coming back in here with negative deltas back into the range that we've been trading. Now, again, this line here in the middle of the chart, this is a line that indicates where the opening price is. And, oftentimes on markets that are balanced, that are rotating, they tend to rotate around the opening price level. And when I see price rotating around, trading a little bit below, a little bit above, a little bit below, a little bit above, it's telling me it's a market that right now has very little direction. If we're trading far away from the opening price, it would tell me that other time frame traders, the traders that can move the market, are in control. But you don't see that here. Right? You're lacking that. That's why you see a lot of small deltas as you're just right around the opening price, this yellow line, 56, 40, 132, 141, 28, 46, 65. That's a sign of a market that's going nowhere fast, right? Just rotating around, not doing much of anything. Now, with delta, there are 6 distinct scenarios involving delta and price movement. The first one is expanding delta with price moving higher or sideways. Second one is expanding delta with price moving sideways. Third one is contracting delta with price moving sideways or higher. Fourth one, contracting delta with price moving sideways. Fifth one, consistent delta with price moving higher or sideways. Sixth, consistent delta with price moving sideways. So what does that mean exactly? I'm going to break it all down here for you. So expanding delta with price moving higher or lower. When the market is in an uptrend or downtrend and aggressive traders are growing in size, chances are the market will continue in that direction, are quite high. So for example, we're at our high of the day here. Okay, so what you're going to be looking for is, like I said, first one is expanding delta with price moving higher or lower. We're at our high of the day. What's the market going to do? We're going to sell off, or we're going to keep rallying up to new highs? Well, here you can see the market sold off. What's the clues here in the delta? Is there any clues? Well, down here you can see the delta is getting stronger as we just start going sideways off this high, but then boom, it breaks. Look at the deltas: minus 102, minus 222, minus 344, and then it breaks from 38 down to 20. Almost a 20-cent move, but you can see it happening right here, picking up as it moves from the 38 level down to the 22 level. And on a move higher, okay, market just, it's rallied up, then it just sort of goes sideways. Then the market sort of picks up its head of steam right here, 99, 105, 201. It's getting stronger, right? Delta is expanding as price is moving higher, right? If you're looking at this case, delta is expanding in the negative sense as price is moving down. So the second one is expanding delta with price moving sideways. Now, when there's a lack of market direction, but the aggressive buyers are growing in size, the market has a strong chance to surge to the upside as the buyers are quietly accumulating or distributing a position. Well, to the upside, they would be accumulating a position. To the downside, if the market was going to break to the downside, they'd be slowly distributing a position. Now, when the passive traders are finished in the market, there's often little to stop the aggressive traders. And what that means is, here's a market that's going sideways, right? Market's just going sideways, and you can see the sellers here, minus 95, this area right in here, minus 95, minus 271, minus 597, right? We're still going sideways. We're still in this range. But you have to ask yourself, how can I be positioned, right? You know that there's support down here because you have strong sellers selling, but the market's not moving anywhere. So you got to ask yourself, if we break through this level down here, once these buyers are satisfied, what's the market going to do? Market's going to break, right? Which it does. You can see it goes from 31.19 straight down to 31.13. Okay, so the next one is contracting delta with price moving higher or lower. When the market is moving in a direction up or down, but delta is getting smaller, the chances are the move is coming to an end as aggressive traders are getting less and less aggressive. And also, they're possibly being met by opposing aggressive traders, which is causing delta to contract. And what that means is when delta is contracting, it's getting smaller as trading is going on, right? So here you have this move, right? We sold off, bounced up, sold off again. What's happening in the delta as we're coming down into this low? Minus 501, minus 300, minus 33. Well, the sellers aren't as aggressive anymore, right? They're drying up. Where's your aggressive selling? How can this market continue going down if there's no more aggressive selling? Instead, you see the aggressive buying come in, 52, 313, boom, market pops back up. Basically a quick 10 points from 56 straight up to 66 over the next couple of bars. As we come up to the highs, all right, watch this. We're going up to this swing high up here, but as we're doing it, the buyers are getting weak. You see 254 here, 4, 3, just right over here as on the move up. Right, you're going up on weaker buying, and then you get up in here at the highs and you see the negative deltas, 116, 100, 167, 140. That's not a good sign of a market that's going to go higher. When you're at a swing high and all you're seeing is aggressive selling coming in, then the market moves back down, another basically 15, 20 cents almost, over the next 10, 15 bars right there. Number 4 is contracting delta with price moving sideways. When you see very little aggressive buying and aggressive selling and the market is moving sideways, look at where the market is trading in the overall structure. Are we at highs or lows? If so, watch for other pieces of order flow to help determine the direction of the market once it starts to move. The market is most likely consolidating under these conditions. Okay, so here you got contracting delta, minus 147, minus 63, minus 4. What's happening? Just going sideways. Just going sideways. We're already going sideways. You see the strong delta here. Okay, well, what happens next? Weaker delta. What happens next? Weaker delta. Then we just continue the weak deltas. You get one strong negative delta. Then it just continues with weakening deltas. It's not moving anywhere, and the deltas are not expanding. Okay, here's one. This is E-minis. This is a 1 minute chart. You gotta ask yourself, what's happening in the market? Okay, we're just going sideways. You can see the deltas right in here just before 940 and 938. You got a strong positive delta of 475. Okay, 237, 77. It's weakening, right? Then all of a sudden you see the delta getting stronger, minus 95, minus 271, minus 597. So you had the buying getting weak here, 475, 237, 77, and the selling getting strong. What do you think the market's going to do? Well, we're going sideways. Buying's getting weak, selling's picking up. I would venture to guess. It's not really a guess. This is one of those slam dunk trades. When you see buying weakening, selling getting stronger, you're going to get short, right? And we break down into new lows. Now, consistent delta with price moving higher, when delta is consistent, meaning staying positive in an uptrend, even if not expanding, and the market is trading higher, it indicates that aggressive buyers are in control. In a downtrend, the delta stays negative and price is moving lower. That's a sign that aggressive sellers are in control. And by consistent delta, what I mean is it stays positive. It doesn't have to keep expanding. But as you can see here, right, this is that low from earlier. I showed you this chart on something else, with the prominent point of controls, but you can see the deltas are staying consistent, off the lows. Positive 243, positive 280, positive 175, 68. Yes, it's getting weaker there, but then it gets strong again, 329, 61, 115. All too often people like to have some sort of exactness in trading and say, well, I can only look at it if delta is getting stronger or weaker or moving, getting bigger. 321, 329, this should be 361, this should be 415. No, it's being consistent. It's still positive and it's still decent numbers. Here, even if you break it up over 5-minute periods, here you got 280, here you got 329, here you got 355. It's staying consistent on that move up. On a move down, this is what it's going to look like. You hit your high up here, you got negative delta, 220, minus 414, minus 360, minus 108, minus 85, selling reappears, minus 609, minus 398. Just because you say, well, you see delta is getting weaker here, minus 414, minus 360, minus 108. Well, that doesn't necessarily mean you got to be buying it right now. Price is still moving lower. Points of control are still moving lower. As the market just continues selling off, it's staying consistent, minus 398, minus 382, minus 243, minus 116, and so on as the market continues its march downwards. And lastly is consistent delta with price moving sideways. When delta stays positive, not expanding, but the market is not necessarily going higher or lower, it's indicative of a market that doesn't quite have enough aggressive buying to move it higher. The aggressive buying is being shut off by the aggressive selling just enough to keep prices from going higher. So consistent delta with price moving sideways. Okay, It's a good example. Price moving sideways for the most part. It's sort of in this 20-cent range. 57.40 to 57.60. And you can see it's going back and forth. Here you got positive delta, negative, we'll start here, negative delta 420 comes right back with positive delta of 279. Then it goes sideways, small deltas. Positive delta 450. Hey, this is it. We're going to move higher. 189. Okay, that's nice. And then it just comes right back in. Strong negative delta 598. Delta of minus 35. Yeah, that's nothing. 102. Okay, kind of nothing. Then 260. Okay, maybe we're going to make another run up here. 260 is a decent number. It's getting stronger. Then it comes back in with the negative delta. 26. 180. And then positive 24. 100, 178, 78, then 390. Oh, this is it. We're going to take off. We're going to go up to $58. Then 9. Okay, neutral. 62. Okay, borderline. Then strong selling comes back in, minus 239. Then, 83, negative, positive 111. Then negative again, 203. And it's just going back and forth. This is more often than not, this is sort of the patterns you get with delta on the sideways markets, where you get these little pops, with strong positive deltas in one direction, and then obviously you get the negative deltas in the other direction, and they just sort of cancel each other out. Here's a good example. This is E-minis. This is a 1-minute chart. This is during the daytime. You see the market's just flatlined. And you can see there's buying comes in, selling comes in. Selling minus 895, then it just comes right back with positive 753, small deltas. Selling comes in, minus 516. Buying comes in, 318. Selling comes in, minus 239. And it's just going nowhere, right? When you see these deltas, when you see price going sideways and you see deltas sort of alternating, even though there's other bars in between with small numbers, just understand what's happening, right? Take it in context of the market. I know this is the opening price line right here, this yellow line. Market isn't moving, and I'm getting alternate delta. So I'm not going to get excited when I see minus 893. I'm not going to get excited when I see positive 753. I'm not going to get excited when I see minus 516, because we're going sideways. I know that. If we start breaking out, then I'll get excited. If I start seeing something in the delta, then I'll get excited. But when I say consistent, right, this one I call consistent delta with price moving sideways. I guess the proper way to say it would be consistent, inconsistent delta. Consistently inconsistent, where it's alternating positive to negative back and forth. So, these 6 delta and price relationships are going to help you gauge the current market environment and give you insight into potential direction in the immediate terms. Honestly, the ones that I find most useful are, let's go back to the expanding delta with price moving higher or lower, contracting delta with price moving higher or lower. Those are the ones that I find the most useful in my own trading, but you should know the other ones and how the market reacts to it. Now, delta at support, all right, when delta at a support level is not positive and becoming increasingly negative, there's a strong chance the support will break. Delta at resistance, when delta is at a resistance level, it's positive. When the delta is positive and strong, it's the sign the resistance won't offer much resistance. You can look at this 2 ways. Okay, I don't like to say it. This is how it is. Period. Right? When you're looking at a support level, okay, I'm not talking about based on the delta, right? Based on a prominent point of control. Watch what's happening. Watch if it breaks. Okay, so when you're coming down to a support level and the delta is not positive and becomes increasingly negative, that means somebody is selling into that support area. So obviously, if that passive buyer there, the one that is absorbing all the buying, the selling that's going on, if he can't take it anymore, we're going to have a strong break. Now, conversely, at resistance, right, when the market's going up and you have a resistance level, delta is positive, right, and it's getting stronger positive, and finally it's going to get past it, right, then obviously we're going to keep going higher, right? it has to eat through a lot of offers to the upside. And if you're looking at strong deltas, it's telling you the aggressive buyers or aggressive sellers are there if it's a strong negative delta. And oftentimes, this is where it gets a little bit complex for people, is you have to look at delta in terms of passive traders and aggressive traders, right? If you have strong positive delta, that means it was met with strong passive trading. And so you have strong positive delta and it gets past that, the bar closes through it, right? And you're into the next bar. It means it just ate through a lot of strong passive selling. Now, when you're at new highs of the day or new contract highs, you often get a lot of size coming in, right? We've never been to these areas before. People are attracted, people want to sell it. Everyone loves to sell the highs. Just bear that in mind, right? When you don't get all excited saying, oh my gosh, we're at these highs of the day, in the S&Ps or NASDAQ, we've never been up here and there's strong size coming in. There's going to be size all the way up, period. And you got to understand, think of it also in terms of the passive buyers, right? Or passive sellers. Once those guys have gotten their fill, if it's a strong passive seller and he sells his inventory, okay, he's happy. He made his money. He's happy to let the market keep going higher, right? If it's a strong passive buyer supporting the market, after he can't support it anymore, what's going to happen? Once his books are full and then he closes them, who's there to support the market? Nobody. It's going to break, right? You got to understand that. Think of it. We all get caught up in looking at the deltas, but you also got to look at it in the opposite direction, in the opposite terms. And, for example, here we go. Where are we here? We're coming down, we get this swing high up here, right? We have resistance, okay? You got negative delta of 76. Why? You're at this high up here. Well, we hit a high, we traded some volume, sellers came in, right? There was strong volume earlier here. You can see 181, 191, 157, but down here, you're not seeing that same sort of volume coming in. On the way up, you can see here the 216, right? You got the big, strong positive delta. We got past it, right? Where's the follow through? Earlier on this move up, on this bar over here, you got nice positive deltas, 268, 317. You can see up here, nice volumes up here on the offer, 277, 136, 198, 219. We got through those areas, right? So you had some resistance coming in up here. But then, the buyers got full. It's like eating at a buffet dinner. You get excited. You come in here, you're eating all you can, eating all the pizza, eating all the pasta, and finally you get up here. Oh, I'm full already. I can't eat anymore. Market drops off. Right? Drops off. Gets down here. You got some support down here. You can see how the volume came in. You got 238 right here on the bid side. It's just spread out over the next couple bars, 110, 112, just above it, you're looking at 160. Market pops up again, then starts coming down. These people that were bidding this market, supporting this market, they're no longer there. Market breaks down, rallies back up to where your previous support was. All right, then it comes off a little bit. But again, you got to take it in context of what the market is doing, right? When you're looking at resistance and support, right? Don't think in terms of aggressive buying and aggressive selling, right? You got to also think, what are the passive traders doing? And that's very important. As you see, as you're going up, okay, I'm just looking at the deltas here. I'm not looking at the actual volumes inside the footprint chart here, because, as you're going up to the new highs, you're seeing obviously the resistance, right? It's running into the resistance, 463, 457, 757. So I know there's resistance up here, and the aggressive buyers are just eating through that. They eat through that, make the new high. 457, I know there's resistance selling up here. We're at new highs. Get through that. They eat that. 757, they get through that. big positive delta. Okay, well, are they, are they done eating, basically? Are they wiping their chins already with their napkins? They can't buy anymore. They're done. That's why all of a sudden it turns sellers. Sellers are coming in because now they're attracted. These people that were selling on the way up, right? And again, this is why people don't understand when the markets are rallying, right? You often get big sellers attracted. Other time frames. When we're rallying, when we're making new highs, that's attracting other time frame traders into the market. If they think it's a good sell, gets to a level, they're selling on the way up, right? If you have a position, you can't just wait for the market. You can just pick a level, wait for the market to hit that level and start selling off, and then you start selling. You need to sell into the rally because that is when the most aggressive buying is happening. That's why often you see when the market finally hits a high and makes a turn, you see the big negative delta coming in because they sense it up here. They sense that, okay, this is about as high as we could go. Start coming off, and they just get aggressive, slam the market. And it's added by all the people that, the shorter time frame traders, the day traders that were buying on the way up. They sense it too, and they start covering their longs. Now here's the market. It's moving down. Okay, we hit these levels, right? You've got bullish prominent point of control. You got another bullish prominent point of control. It's not a bullish prominent point of control, but it's towards the bottom. You got some decent volume. So I know I have this little area in here with support. Okay, so we hit it once, twice, basically a third time. Well, if we're going to test it, it's not like we're just going to keep testing these levels, test it forever. At some point, these buyers are just going to be full up. They can't take anymore, right? And this is where you're going to be seeing it in the order flow. You get a good gauge on what their volume is here, 200, 130. So, you're looking at, several hundred over 500 contracts right here. If we test it again and get through that, boom, it's just, look out below. This is a move. So from basically this area here at 1472.70, down into new lows and even lower. At 70.10, and you can see how this was your support now becomes your resistance, right? So if you're going to rally back up and then it holds, well, chances are we're going down. Okay, so this is E-minis. That previous one was gold, right? And it's the same thing. But in this case, what you have here is market rallied up, starts coming off, the strong supportive buying coming in here, right? Market rallies back up, the buying is still here. You guys still got that volume in here, but then the market turns around and goes back up. And again, if you're watching the delta, right, you see negative delta. Okay, yeah, I got a red candle, I got negative delta, but really, what's the sign in here? It's kind of hidden. If you've studied my delta course, you'd understand this bar right here. This green candle with the negative delta is very, very telling on what's going on, because what happened, right? Market hit your swing high, sold off, rallied up, sold off again. We got the negative delta on this green candle. So early in this bar, you had a very strong negative delta, 400, ended up at minus 163. If you look at the volumes, right, 602, 307, why do you have negative deltas? Because there was strong supportive buying in here. The 602, the 307, right? Next bar, negative delta, 49, kind of small. And it's just kind of, it opened up here, closed down here, and that was it. Couldn't break through that low. It did go offered below 97 and a quarter. It was 97 and a quarter bid. Didn't trade there. Take into account what's happening overall in the delta. It's getting weaker. 277, minus 163, minus 49, right? If we're really going to break down there, you're not going to be looking at this sort of pattern here, minus 277, minus 163, minus 49. If we're going to break, you're going to be looking for, obviously, a break below 97 and a quarter. But you should have generally stronger negative delta. Then it comes back with positive delta, aggressive buying coming in here with stacked buying imbalance. Obviously, the points of controls are higher over the next 3 bars. This red candle, this green candle, this other green candle, it's higher, higher, higher as the market snaps back up. So think about what's happening in terms of not just what the aggressive sellers are. You got to be thinking of what's going on with the passive buyers. Now, when the market is trading sideways, either in congestion or consolidation, keep an eye on the delta and imbalances. Is one side dominating, or is it evenly matched? And obviously the imbalances are going to show the aggression in the bar. Oftentimes you see an expansion of delta in a direction in sideways market as traders are accumulating or distributing a position. Range-bound market is a place where large traders can move volume without moving the market too much. That's why you see delta is getting smaller in range-bound markets, because both big buyers, big sellers can trade without moving the market. So if there's nothing happening that stands out, then there's really isn't any excitement in the market at the moment. So you just wait, right? Eventually, it's going to come to the market, right? Don't sit here and try and force a trade. You don't necessarily need to do that. Sometimes the best trade you can make is no trade. And for example, here we're sort of trading in this nice range, between 30.98, 31.01, and then you just start breaking out, and you see buying imbalance in this bar 1, 2, 3 here. It's not stacked. You don't get the stacked one until a little bit later. But if you're watching where the imbalances are occurring and the quantity of imbalances in a bar, they're right here: 408, 278, 56. Earlier, also where you had the 56, it was also a buying imbalance, 272. So, it's getting more aggressive buying coming in right in here. Obviously, the delta is getting stronger: 39, 78, 800, 82, 1400 before it goes sideways, but then it pops up again. So if you had to make a trade, you could be buying in here at 04, and then over the next 5 minutes, quick 2-point profit, more later if you wanted to. Now, indifferent delta is something that not doesn't really get discussed too often, but what it is, it's low to negative delta at and after a high is made, and that's bearish, right? Lack of aggressive buying, but an increase in aggressive selling is present. And if the aggressive selling attracts other aggressive sellers to the market, then there's a chance for the market to break. Now, oftentimes you get low to negative delta after a high is made, and then you get some low to positive delta after that high is made, and the market just goes sideways. So you got to be watching, what traders are doing. Are they still going in that direction? Have they paused? Or, is somebody starting to assert themselves again? Are the buyers coming back up, and, the market going to go higher? And rising prices with weak enthusiasm, the delta, is also a sign the trend may be ready to pause or potentially reverse as the buying interest has dried up. We sort of talked about this earlier, with the delta price relationships, right? As the market's moving higher, but delta is getting weaker, right? You got positive delta still, but it's dropping off dramatically. Positive 500, then positive 300, positive 100, and then 10, and then minus 50. That's a sign that the aggressive buying is basically dried up. It's being matched with the aggressive selling. So you gotta watch for that, right? Low to positive delta at and after the low is bullish. Okay, so you're at your low. Okay, you're not seeing any negative delta anymore. You're seeing low numbers, but they're starting to turn positive, right? That's like, when you see in the TV shows where the guy is, they think the guy's died, and they're like doing the pads on his chest trying to get a heartbeat. That is your heartbeat coming in there. Once you start seeing the positive deltas, that's a sign of life. So watch for that. Now, what does it look? Here we hit our highs, just sort of hanging around, not really doing much of anything. You got the big negative delta, okay. Then it comes back, small positive, small positive, small positive. It's growing, so maybe thinking, well, it's going to go up. Boom, it's met with more selling. Then small positive, big negative, 267 minus 209. Okay, hey, we're going to sell off. Nope, it's kind of indifferent. Doesn't start picking up till over here again. You get the next move, 70 minus 92 minus 96. You're staring, it's happening right in this stacked buying imbalance. Okay, so this is something that people got to understand. When you're looking at a stacked buying imbalance, you got to be watching what's happening. Don't just buy them blindly. Right? You got to be managing your trade. I'll be talking about trade management later. But when you're looking at the stacked buying imbalance, and then you're 2 bars into it, 3 bars into it, you're still in that buying imbalance. That's not a good sign. You got to be looking for some other signs what's going to happen. And actually you get a nice point of control set up in here. Right in the point of control course, I talk about this relationship with these 2 bars here where the points of controls are coming in. Obviously the deltas are negative and getting stronger. By this bar right here, when it's at minus 111, you should be looking to be getting short. Right? If you're long, forget about it. Then here, minus 380, if you're still not short off this minus 111, by the time this bar comes in, you want to be short already. You don't even need to wait for this bar to close. When you're on a 1-minute chart here, you should have already been short at the minus 111, potentially at the minus 96, but definitely in this bar at minus 380. And then you could catch these moves, where, on the 1-minute chart, the bar where it sells off from 62, 63 down to below 40. The nice 20-cent move in the bar. These are the bars you want as a trader. These are the bars that you dream about. Like as soon as you get short, then the bottom falls out. That's what you want. So delta helps you measure the momentum of a move. When delta is strong, positive, then the momentum is strong as aggressive buyers are strong. Same is true for negative delta, but with the opposite effect. When it's delta is strong negative, then the momentum is strong as the aggressive sellers are strong. The overall picture should weigh heavier in the decision-making process than the setup alone. And what I mean is, the setup gives us the impetus for getting into the trade when it coincides with the context of the market. Don't just get in because there is a setup. All too often people just give me the setup, tell me when to buy and sell, and be done with it. No, you got to take it in the bigger picture, the overall picture, market context for any trade that you're going to take. Markets go up and down because more traders are buying than selling and vice versa, right? We all heard that. Why is the market going up? Well, there's more buyers than sellers. Why is the market going down? There's more sellers than buyers. Well, if they start buying or selling aggressively, causing imbalances after a technical level, I'm going to see that in the order flow and jump in too. There's always going to be some fundamental reason behind moves that make some sense as well. People could always find a reason why the market moved for whatever purpose. But really what you want to find is the market moving before it moves, right? And take advantage of those situations, right? Like you see the big bar right here where it finally popped up. This bar on the right, you got the big strong positive delta, 4,500. The market went from 96 up to 01. But you want to be looking for those signs in here earlier. That can be telling you, to be getting long in the market. Are there? Yeah, there are. I mean, here you got obviously a ratio and divergence. You could be buying off that low. Doesn't test that low again. You got the aggressive, 2 bars with multiple imbalances back to back. You got 3 imbalances there, 3 imbalances there. And you're coming in here, you're starting to see the consistent positive delta as markets moving a little bit higher. At this point, when you get, 2 or 3 bars before you get that big move up, you're asking yourself, what would I rather be, long or short? At this point, you'd rather be long. I mean, here you have the delta going back and forth, plus 700, minus 700, minus 500, minus 600. And then it just sort of slows down. Then you see the aggressive buying coming in. So whatever aggressive selling there was earlier, it's just kind of dried up here. Then you see the aggressive buying slowly creeping in before it pops up. But obviously the main signal was down here. You've already been long off this ratio and divergence. You rally up, you come back. The fact that you get within a couple of ticks of that and it's still holding, it's still bullish. You try to move up here, some selling comes in. Once that selling is no longer there, once it's removed, that's why you get this vacuum here. You see these small prints, 0, 71, 3, 4, right above the high here. Well, it's because the aggressive selling that was coming in every time you got up to 96 is done, right? You slowly creep back up before it gets back up here, then boom, it's gone. Think of it as, you're holding your hand down on something, and say you have a water fountain, okay? You put your hand over the water that's coming out. Well, pressure's building, right? Eventually, you move your hand, the water squirts up. That's what this is, right? So you got the aggressive selling coming in. Market's not going down, right? The aggressive sellers, this is your low. This red line is your low of the day. Aggressive sellers are coming in here. They're trying to push it down. They realize they can't, right? So this is putting your hand over the water fountain, over the hose, right? You're trying to hold that market down. You can't anymore. Finally, forget it. You pull your hand back. Market turns around, boom, pops right up, just like as the water squirts up. So order flow allows a trader to know clearly what other traders are doing when the market reaches important technical levels. Professional traders know what they're going to do, how they're going to trade when the market reaches an important technical level, right? If the market doesn't go to the way they expect at a level, it doesn't make sense. If the market doesn't act the way they expect it, I should change that from go to act, makes better English. They adjust their trading plan accordingly, right? They trade against the weak traders who don't have a plan B, right? They don't wait for the market to stop them out. Why should you? And I'm going to talk about this later when I get to active trade management. Is when the market isn't doing what you expect it to do, you have to adjust your trading, right? Your technical traders, people that backtest the heck out of everything. I found my edge. I was reading about a guy the other day. He's talking about he backtested the stuff, E-mini S&Ps, and is asking the question, I want to trade 20 lots in the E-minis. Is that enough to get filled on the bid and the offer? As if he's going to always get filled on the bid and the offer. And I was just like, well, there's no guarantee, especially in the E-minis. Put your 20 lot in, you could be behind 400 and it trades 399. You don't get anything. And I'm like, so you're going to have to chase it, right? You might lose a tick or two. So if I lose, I can't. If I lose a tick, then this method of trading isn't going to work. Well, then you better find a different way to trade. Don't be so caught up that you're so fixed in your trading that you're either going to take a full profit or take a full loss. You got to be able to adjust. You got to be flexible in the markets. Trying to predict the future price in the market is fun. We all see these contests the exchange run. Guess where this market's going to be? Guess where the S&Ps are going to be trading 3 months time at the end of the year or something like that. Yeah, that's fun to do. But very few traders can do that and make money consistently and profit doing that. I've been around some of the brightest economists in the world. Believe me, if you ask them how much money they made on their predictions, you could buy a cup of coffee. I've worked with guys that are brilliant economists, but they don't trade. They sit here. Well, I see the big picture is like this. Grand scheme of the market's going to go up. Okay, well, are you long? No. So predicting it is one thing, trading it is another thing. I realized to make money as a trader, I was best served learning how to read what was happening in the market based on what was actually happening in the market right now in the order flow. For a move to continue, there needs to be new traders coming in to give support to the move. If there's little to no aggressive buying on a move up, the move's going to end, right? And how can you see that? You can see that in the delta. That's the most obvious way to see it. The same is true for a move down. You need aggressive sellers to keep the move going down. This is why I like seeing consistent buying in an up move or consistent selling in a move down. When a spike in volume appears, it can signal the end of the move because too many buyers or sellers came in at once. And this is something that not a lot of traders really comprehend. And a friend of mine is the one that taught me that. Well, he didn't really teach it to me, but just sort of pointed it out. I sort of knew that is when you see, we get mesmerized sometimes by big numbers, like big deltas, big volume. And we think, oh, this is it. Everyone's coming in, like Bitcoin, right? Market's rallying up. Everyone's and their brothers buying Bitcoin. Well, once, that's the euphoric state of the market. And it's often the end of the move because, everyone's coming in. The last people that you expect to come in, the woman that runs the dry cleaners down the street, all of a sudden is buying Bitcoin. Well, you've pretty much exhausted the entire market of people that's coming in to buy Bitcoin. In a sense, it's not going to go up anymore. There's not going to be new longs coming in. There's not going to be new shorts coming in. On a move down, keep the direction going. Too much volume at once is not necessarily a good thing. I like to see healthy volume in the market, but too much of it's like too much chocolate. It's going to get you sick. Too much volume is going to cause the market to vomit in a sense. Here's the market's nice methodical move up, right? Consistent volume, consistent deltas, higher points of controls, and then boom, oh my gosh, boom, 20,000 contracts. When earlier your biggest volume is 3,600, but your average volume is, you're looking at 2,000, 2,100. All of a sudden you trade 10 times the volume. Market comes in, goes a little bit higher in the next bar, and that's it. Everyone that wanted to buy, they did already, right? There's no one left to support that move up, and the market starts dropping back down. I mean, you could see, when you see this nice, slow, methodical moves up, even within it, you got some trends in one direction and the other. Higher point of controls, comes off a little bit sideways, higher points of controls as you're going up. Boom, jumps up here. Then what happens? You go from positive delta of 5,000, positive delta of 264, then strong negative delta of 400, 571. It's just trickling down. You don't have that supportive buying coming in anymore to keep that move alive. So the more aggressive buyers that are present means price is going to go up. Yeah, obviously. The more aggressive sellers that are present means price is going down. Nothing else matters. Professional traders know that the market participants' habits are, and that's why they're consistent winners over time, right? They know, right? The big traders know that we get that pop up. Okay, well, who's left to buy it? No one. Okay, I could sell the heck out of it here because we're artificially high. We got everybody, the guy on Main Street coming in, buying it. Okay, well, now's a good time to sell it, because he's not there anymore to buy it, and the market sells off. So once you start watching the market on a regular basis, you start to understand when the market is exhibiting strength or weakness. You're going to see opportunities coming along regularly. People think they always got to be trading. Oh, I got to be in the market. I got to be doing this. I got to be doing that. No, there's times to take a trade. There's times not to. Market's going to be there for you, and they're going to come along fairly regularly. I talk about 11 different setups later, and not all of them appear every single day. I even talk about, I got a module on nuances in the order flow. Some of those things, you go 2, 3, 4 days without seeing one of those things. But, you got to be aware of it because, when the situation is there, you got to act on it, right? That's why I want to get it out so you're aware of it, know what to look for, and say, yeah, that makes sense. I understand why that's happening. You don't need a degree in advanced combinatorial math or a doctorate in finance to succeed in trading. You just need common sense and to be able to recognize when traders and the market are exhibiting strength or weakness and have the ability to act on it, right? That's the most important thing, is you got to act on it, right? If you see something happening, you have to do something about it, right? So you've reached the end of Module 1. In Module 2, I'll discuss finding the order flow honey hole. That's going to be an interesting one. So I'll see you on the next module.